The financial crisis and the Great Recession pose the most significant macroeconomic challenges for the United States in a half-century, leaving behind high unemployment and below-target inflation and calling for highly accommodative monetary policies. The financial crisis revealed important weaknesses in many areas of our financial system. We live in a world defined by the rapid pace of technological change. The longer workers are unemployed, the greater the likelihood that their skills will erode and workers will lose attachment to the labor force, permanently damaging the economy's dynamism and potential output. I am unable to think of any critical, complex human activity that could be safely reduced to a simple summary equation. There is no risk-free path for monetary policy. My own experience is that the best outcomes are reached when opposing viewpoints are clearly and strongly presented before decisions are made. A digital currency issued by a central bank would be a global target for cyber attacks, cyber counterfeiting, and cyber theft. Alignment of business strategy and risk appetite should minimize the firm's exposure to large and unexpected losses. In addition, the firm's risk management capabilities need to be commensurate with the risks it expects to take. Long experience, in the United States and in other advanced economies, has demonstrated that monetary policy is most successful when decisions are rendered independent of influence by elected officials. We need a national focus on increasing the sustainable growth rate of our economy. Mobile devices, high-speed data communication, and online commerce are creating expectations that convenient, secure, real-time payment and banking capabilities should be available whenever and wherever they are needed. The success of monetary policy should be judged by the economy's performance against our statutory mandates of price stability and maximum employment. There is certainly a role for regulation, but regulation should always take into account the impact that it has on markets, a balance that must be constantly weighed. The United States has never prioritized or failed to pay any obligation when due during a debt limit impasse. Despite the institutional risks and the lack of clear legal authority, we assume that Treasury will attempt to prioritize payments in a last-ditch effort to avoid default. While monetary policy can contribute to growth by supporting a durable expansion in a context of price stability, it cannot reliably affect the long-run sustainable level of the economy's growth. All economic forecasts are subject to considerable uncertainty. There is always a wide range of plausible outcomes for important economic variables, including the federal funds rate. The only way to ensure that inflation expectations remain safely anchored near the FOMC's target is to keep inflation close to that target on a consistent basis. More regulation is not the best answer to every problem. The financial crisis involves significant failures in the functioning, regulation, and supervision of OTC derivatives markets. The Federal Reserve is committed to fulfilling our statutory mandate of stable prices and maximum employment. Although I have never worked in a community bank, I have been a customer, and I know from personal experience the special skills that these institutions bring to their customers.